Just moments ago, the latest inflation numbers were released. Most analysts are focused on what this means for interest rates. They're analyzing the Fed's next move. They're debating whether we're heading into recession or stagflation. They are missing the real story. They are looking at the smoke and ignoring the earthquake that just happened underneath the financial world. That inflation number wasn't just a number, it was a trigger. It was the final piece of evidence that proves the silver paper game has passed the point of no return. This video is not a prediction. It is a presentation of evidence. I'm going to show you, using real-world data, why that inflation report just made a default on the COMEX silver market, a mathematical, economic, and historical inevitability. Let's examine the evidence. Before we can understand why default is inevitable, you need to understand how COMEX actually works. What COMEX actually is. COMEX is the world's largest silver futures exchange. It's where the global price of silver is determined. But here's the critical detail most people don't understand. COMEX trades futures contracts, not actual metal. A futures contract is a promise to deliver silver at a future date. It's a paper agreement. Less than 2% of COMEX trades ever result in physical delivery of actual silver. The entire system relies on one fundamental assumption, that almost nobody will ask for the real metal. Registered versus eligible silver. This distinction is crucial. Eligible silver, metal stored in COMEX-approved vaults but not pledged for delivery. It's just sitting there. Owners can remove it any time. Registered silver, metal specifically designated as available to fulfill delivery obligations on futures contracts. Only registered silver can be used to settle contracts when someone demands physical delivery. The default threat emerges when registered inventory falls below delivery demand. The new data point. Here's what the latest data reveals. Delivery requests are rising at an accelerating rate. Industrial buyers who used to settle in cash are now demanding physical metal. Registered inventory is hitting multi-year lows. The amount of silver actually available for delivery is shrinking rapidly. Industrial demand is straining supply availability. Manufacturing sectors can't reduce their silver usage. The technology requires it. Vault outflows are accelerating. More silver is leaving the COMEX system than entering it. The contradiction. But here's where the numbers stop making sense. If paper selling is supposedly crushing demand and driving prices down, then why is physical inventory draining faster than any time in the past decade? The paper market says one thing. The physical market says the opposite. One of them is lying, and physical reality doesn't lie. Let me show you why a COMEX delivery crunch is mathematically unavoidable. The paper versus physical disconnect. COMEX trades paper contracts that can be created with a keystroke. Industrial buyers need actual metal, atoms of silver they can use in manufacturing. Paper price does not equal physical availability. You can print infinite contracts. You cannot print silver. Industrial demand is exploding. Let's look at the documented demand categories. Electric vehicle industry. Every EV requires 25-50 grams of silver. Global EV production is doubling every 18 months. This demand is non-negotiable. The electrical systems require silver's conductivity. Solar panels. Every panel needs approximately 20 grams. Solar installations are at record levels globally and accelerating as countries pursue renewable energy mandates. Aerospace and defense. Advanced missile systems, radar, and avionics all require silver. Defense spending is increasing, and this demand is completely inelastic. AI data centers, high-performance computing requires silver for optimal electrical connections. AI infrastructure spending is exploding. Medical and electronics. From antibacterial coatings to advanced circuit boards, silver is essential and irreplaceable in many applications. Understanding inelastic demand. This is the key concept. Industrial demand for silver is inelastic. That means companies cannot reduce usage even if prices rise. The technology requires specific amounts of silver to function. Tesla can't build an EV with 20% less silver and hope it works. The Pentagon can't make missiles with substitute materials. This creates unavoidable strain on supply. The inventory drain pattern. This pattern has appeared before in other commodity markets. Nickel, 2022. London Metal Exchange faced a delivery squeeze. Prices spiked 250% in 2 days. Trading had to be suspended. Gold delivery stress 2020. During COVID, physical gold became impossible to source even as paper prices fell. Premiums exploded. Silver squeeze attempts 2021. Retail investors tried to force delivery. COMEX survived, but only because industrial demand wasn't yet critical. London bullion outflows. Physical gold and silver have been steadily draining from London vaults to Asia for years. Every commodity squeeze follows the same pattern. Paper abundance meets physical scarcity. The paper market eventually breaks. The game-changing shift. But what happened last quarter is what truly changes the future of silver, because for the first time, Industrial buyers began demanding direct physical delivery from COMEX. Let me explain why this breaks everything. Large buyers. Switching to COMEX. Historically, industrial companies bought silver through wholesalers and refineries. They never interacted directly with COMEX, but supply shortages and delivery delays have pushed them upstream. Now, major manufacturers are bypassing traditional suppliers and requesting silver bars directly from COMEX vaults. This is unprecedented behavior, and it reveals desperation. Why this breaks the system. COMEX was never designed for mass physical withdrawal. The system only works under 3 conditions. Condition 1, most contracts are cash settled instead of physically delivered. Condition 2, traders roll over their contracts to future months instead of taking delivery. Condition 3, physical delivery demand stays low and predictable. Large-scale physical withdrawals violate all 3 conditions simultaneously. The mechanics of breaking think of COMEX like a fractional reserve bank. A bank holds $100 million in deposits, but only keeps $10 million in the vault. This works fine as long as everyone doesn't withdraw simultaneously. COMEX holds contracts representing hundreds of millions of ounces, but only has a fraction available in registered inventory. This works fine as long as nobody actually asks for the metal. But when industrial buyers start demanding delivery, the fractional reserve facade collapses. Pattern of a coming default. Let's look at the warning signs. Registered stock, at multi-year lows and declining. Open interest, extremely high, representing massive paper claims. Delivery requests, rising month over month. Fractional reserve ratio, dangerously leveraged, far beyond sustainable levels. Every indicator is flashing red. The number that terrifies institutional analysts. And now we get to the number that terrifies every institutional analyst who understands this market. The coverage ratio. Because once you see it, you'll understand why COMEX cannot mathematically survive a large delivery wave. What the coverage ratio is, the coverage ratio measures the amount of silver owed through contracts versus the amount of silver actually available for delivery. It's the most important metric for assessing default risk. If the ratio gets too high, the exchange cannot fulfill its obligations. Default becomes inevitable. Historical ratios versus today. Let me give you the educational comparison. Healthy ratio, 1.1 to 10.1. This means for every ounce owed, there are between 1 and 10 ounces available. The system has comfortable buffer. Stress ratio, 21 to 50.1. Warning signs appear. The system is leveraged but can survive if delivery requests stay moderate. Current pattern. The ratio has been pushed to extreme levels where paper claims vastly exceed physical availability. The exact number fluctuates, but the trend is undeniable. Claims are growing while registered inventory is shrinking. Why the math stops working? The formula is simple. Coverage ratio, R's, total ounces owed, registered ounces available. As the numerator increases, more contracts sold, and the denominator decreases, less registered silver, the ratio explodes. At a certain point, the numbers become impossible to reconcile with physical reality. The 5 simultaneous pressures. The ratio is being squeezed from multiple directions at once. Pressure. 1. Physical demand rising. Industrial buyers need more silver, not less. Pressure. System 2. New supply. Declining. Mine production is flat or falling. New discoveries are rare. Pressure 3. Registered supply shrinking. Owners are converting registered to eligible and removing it from the system. Pressure 4. Industrial users. Requesting delivery, companies that never took delivery before are now demanding physical metal. Pressure 5. Investors. Removing silver, smart money is pulling metal out of the exchange system entirely. All 5 pressures are active right now, simultaneously. The mathematical inevitability. When you combine rising claims with shrinking inventory, the math leads to one conclusion. At some point, and that point is approaching fast, delivery requests will exceed available supply. When that happens, COMEX faces a binary choice, the breaking point. And this is where the system faces its breaking point. Because COMEX has only 2 options left, and both lead to the same outcome. Let me walk you through both scenarios. Outcome 1, cash settlement. COMEX could offer cash instead of metal to contract holders demanding delivery. This has happened in other commodity markets before. It prevents an official default on paper, but here's what it actually means. It destroys confidence. If the exchange that sets the global price admits it can't deliver the underlying asset, trust evaporates. Physical price decouples. When people realize paper contracts are worthless, they'll only trade physical metal. 2 separate markets emerge. Premium explosion. Physical silver will trade at massive premiums over the paper price. The official price becomes meaningless. Cash settlement isn't a solution. It's an admission of failure that triggers the very crisis it tries to prevent. Outcome 2, delivery delay, not rule change. Alternatively, COMEX could implement emergency rule changes, administrative delays on delivery requests, special conditions forcing traders to roll contracts forward, increased margin requirements that make taking delivery prohibitively expensive. Why this also fails. Rule changes signal weakness and create panic. If the exchange has to change rules mid-game, everyone knows the game is broken. Sophisticated players will immediately recognize this as a precursor to full default and rush to exit their positions. This accelerates the very crisis the rule changes tried to prevent. Both lead to the same result. Whether COMEX chooses cash settlement or rule changes, the outcome is identical. The paper market loses credibility. Physical price discovery moves outside the COMEX system. Silver begins trading based on actual supply and demand, not paper manipulation, the decoupling. And when that moment happens, silver won't behave like a volatile commodity anymore. It will behave exactly like every suppressed asset in history right before a revaluation. Let me show you what that looks like. What happens after suppression? Breaks history provides clear examples of what happens when artificially suppressed prices meet physical reality. Gold, 1971. When the dollar gold peg broke, gold wasn't allowed to trade freely. Once it was, the price exploded from $35 to $850 over the next decade. Nickel, 2022. The London Metal Exchange faced a delivery crisis. Nickel spiked from $25,000 per ton to $100,000 in 48 hours before trading was suspended. Uranium, 2006. After years of underinvestment, uranium went from $20 to $137 per pound when supply couldn't meet nuclear power plant demand. Oil supercycle. When crude oil supply couldn't keep pace with global growth, prices went from $20 to $147 despite all attempts at control. Wheat shortages. During supply crises, wheat prices have spiked 300–400% as governments competed for limited supply. The pattern is always the same. Artificial suppression creates the conditions for explosive revaluation. Why silver's move is bigger. Silver is unique because it's simultaneously a monetary metal, historically used as currency, still viewed as a store of value, an industrial metal, essential for modern technology with no substitute. This dual nature means it faces pressure from both monetary hedge demand and industrial necessity. Gold is primarily monetary, copper is primarily industrial, silver is both. Additional amplifying factors. Underpriced for decades, silver has been suppressed longer than any other commodity, creating massive pent-up revaluation potential. Supply deficit developing, annual demand exceeds annual production, draining existing stockpiles. No easy substitutes. Many industrial applications have tried to replace silver with cheaper alternatives. Most have failed because silver's properties are unique. Small market size. The entire global silver market is smaller than many individual tech stocks. Even modest capital inflows create massive price impact. The three-stage revaluation pattern. Based on historical commodity cycles, here's how silver's revaluation will likely unfold. Stage 1, the cracks now. Physical premiums rising, delivery delays increasing, registered inventory declining, smart money accumulating quietly. Most people don't notice yet. Mainstream analysts dismiss it. Stage 2, the rush coming. COMEX default or rule change triggers awareness. Industrial buyers panic about supply. Investment demand surges as people realize paper is worthless. Physical metal becomes difficult or impossible to source at any price. This is when price moves violently, potentially doubling or tripling in weeks. Stage 3, the repricing. Inevitable. New equilibrium is established at much higher prices. Silver is revalued to reflect its true scarcity and industrial criticality. The old price is remembered as an artifact of manipulation. The new price reflects physical reality. This stage can last years or decades at sustainably higher levels. Engagement question comment. Below, do you think silver will revalue above $50 or above $100? I want to know where this community thinks the new equilibrium will settle. Let me bring this together. The educational truth. Paper markets and physical markets are not the same thing. Delivery demand is rising as industrial buyers lose faith in traditional supply chains. Industrial demand is increasing due to technological trends that cannot reverse. Registered inventory is declining as metal drains from the exchange system. The system was built on assumptions that are now failing. The conclusion. The COMEX silver structure worked flawlessly for decades until physical demand challenged the foundation. And once that foundation cracks, default is no longer a question of if, it's only a question of when. Every indicator, coverage ratios, inventory levels, delivery patterns, industrial demand, points in the same direction. The mathematics of the situation have become unsustainable. What this means: 1 minute ago, inflation data was released. Most people saw just another number, but that number confirmed what the physical market has been screaming. Real assets are repricing against paper promises. Silver is a real asset facing paper suppression. That suppression just became mathematically impossible to maintain. The default isn't coming because someone wants it to happen. It's coming because the numbers don't work anymore.